Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to be able to answer your questions today. I know we already had some come in this week. I appreciate that very much. If you want to ask a question, you just send an email to asktom@talkmoneywithtom.com. And Eason is here with me today. Katie's usually here, actually doing the moderating. She's out of town this week, so Eason's going to do the moderating, some follow-up questions, fill in some of the blanks for some of the questions for some of the things that I might have missed. And you can also ask Eason a question directly, no problem with that. And so this is a show that is designed to try to help you increase your investor education. We believe that, increasing wealth goes hand in hand with increasing your investor education. So that's what this is about. The channel that you're on here, this Talk Money with Tom channel, YouTube channel, we post a tremendous amount of educational investor education content. So if you'd like to subscribe, you just hit the subscribe button there. If you want to not subscribe and just get on our email list, you can just email, your desires to the Ask Tom email address there, and we'll put you on our email list and send you a link to the videos that we post. If you have something more custom or personalized or private that you want to talk about, you can go to our website. The link is there on the channel, and then hit the book appointment, schedule, a 30-minute phone appointment or video appointment, and we'll sit down and talk with you and see if we can help you figure out what it is that you're trying to figure out. So, one of our biggest objectives is really, our specialty area, which is retirement. We believe that there's lots of different financial goals that people have, but the biggest one and maybe the most satisfying to get right is the retirement goal. So that's a lot of what we'll talk about. We get a lot of questions about that, and you can tell it's an important category to people as a whole also. So I like to start off the show with a conversation about kind of a summary of what I see happening in the stock market for the week. This week I really saw amazing things happen. I mean, the key thing that I think is most incredible is, number one, is of the 5 days this week, we hit a new all-time high. For example, on the S&P 500, 4 of the 5 days, including today. And so it's just an amazing market. And let me share a chart with you, and I'll try to describe what I see. So this is a chart. I'll just tell you what's in this chart first. This is the S&P 500 for the last 2 years. And you can see here these little, red and green boxes. These are candlestick chart. Those are, days for each one of those. And then this blue line is very important to me. This is the 200-day moving average. And so each point on this line is the average of 200 previous days. And so a couple of things that you want to note here that I think are important. The more that you can learn about these types of things, the better investor you can be. So first of all, this downturn that we had, back the top here was February 19th. The bottom was the 23rd of March. That very short time period, basically almost a month, a little bit more than a month, the S&P 500 dropped 35%. So that's the fastest drop of 35% in history. And one of the things I think that does confuse people in total is, these downturns are usually caused by recessions and economic issues that are happening. There was some slowing, economic issue happening here in 2019, but nothing really approaching recession yet. This is actually a shutdown from a virus that then caused a recession, which was one of the shortest recessions in history. It was only two quarters, sorry. But several things happened. We've had this unbelievable recovery that has happened. And all along here, keep in mind, there have been people that are saying the market's going to crash, the market's going to crash, the market's going to crash. And we just had some huge things happen. Number one, right in this time frame here, we had the best 50 days in the history of the stock market. And from the bottom up to where we are now, we had the fastest doubling of the market in that time frame. So it went over 100% faster than it's ever gone before. Here, from the end of October till now, we've now had 205 trading days without at least a 5% downturn. So there's only 7 of those that have happened that are longer. The longest one is 404 days, so it can still go longer. But it's very incredible what's happening here. And so the pattern here is very unusual, and people are worried about, hey, the stock market's going to crash, it's going too high, it's going too long. Well, got to look at the pattern a little bit before you decide on what's going to happen there. Number one is the 200-day moving average is very nicely sloped upward. I mean, that is incredible. And the price is well above the 200-day moving average, which means the price is still accelerating at an even faster pace. So for example, the 200-day average right now is 4,039 and it's at 4,500. So it's way up there. It's doing really well. It's got some room to give back if it needs to. But let me show you what the tops look like in the last two big downturns. So the 2000 downturn, which is the third biggest downturn in history, and the 2008 downturn, which is the second biggest downturn. So here's what 2000 looks like. A completely different top compared to where we are now. First of all, you can see there's lots of, 5% plus downturns happening here. Very, very volatile. S&P 500 is trending upward, but the price keeps falling through the 200-day moving average. Sorry, 200-day moving average trending upward before it collapsed, right? Here's the 2008 downturn. Smoother, but still lots of little downturns and lots of incursions past the 200-day moving average before it collapsed. What happens when the price gets down towards this 200-day moving average? What that tells you is that the momentum is slowing down. And so if you look at, here we are again today, this is showing unbelievable momentum. And so my last point, and this is maybe really interesting to me at least, is the fact that I've not seen what we're happening right now as much as I'm seeing now, what I'm calling buy the dip. This concept of coming in whenever the market does drop a little bit and buying. If you look at this year, here's a little dip, here's a little dip, here's another one. One of the things you'll notice if you look closely, for the most part, they're getting smaller. This last one, just last week, the Federal Reserve minutes came out and they were talking about cutting back on their purchase of bond by the end of this year, and the market sold off for a couple days, and boom, money came in. And so one of the things to keep in mind here, and not to get too nervous about what's going on, is this buy the dip concept is really driving this market. Now, at some point in time, that can change, and we will watch for that. But at the moment, that's what's working. And so every time the market comes down a little bit, that's not a bad thing. It kind of releases some pressure. But what it really does is it brings in these buy the dip people, and they come in and push it up to a new high, which is exactly what happened. We had a little downturn last week, and then we end up with this new high, by Monday, and then new high on Tuesday, new high on Wednesday, and a new high today on Friday. So that's kind of what I see, a really interesting time frame. These things are unprecedented that I'm talking about, at least in my career and my observations. This is a very unusual market. The basics are so strong, and be very careful about listening to too many people talking about how things are going to fall apart. They will fall apart someday, but the basics haven't changed at all. The Delta variant is coming up. It's scary. It's a health, issue and what have you. But you see the market is still marching forward because what we've seen so far from that is not massive economic slowdown. And I don't think we're going to shut down again either. So, if that's not going to happen, we're going to keep going. Interest rates are one of the key issues, and we're still at very low rates and what have you. So anyway, that's what I see happening right now. And I really look forward to kind of talking about this again next week, and we'll see where it goes from there. All right, Eason, let's get started with some of the questions. I'm excited to work on these today.
Yeah, so just going off your weekly summary, the first question is why should I stay in the market if I feel we're going to have a downturn soon?
Yeah, well, that's a good question, right? I mean, so if you feel like we're going to have a downturn, well, one of the first things you got to think about there really quickly, okay, because it's really interesting, and I have run across this a lot. Um, there are people that are really, really, really good at looking at the markets and understanding the markets, and have spent a lifetime looking at the markets, who don't know that a downturn is going to come. They might think one's going to come, or they might have some thought process as to why one might be coming, but they don't actually know. Nobody knows, including the person is probably asking this question. That's one of the things we have to remember always, and have some humility about the market. And I know I have to remind myself constantly of that, is that, we don't know there's going to be a downturn. If we go back, matter of fact, let me just share that again. It's kind of amazing. We had some very major investors, George Soros included and whatnot, that felt like this market was going to go way farther down during this downturn. They were wrong. We have had all along here people that felt the market was going to go down. It doubled. right? It just in this very short period of time. And so you just want to invest. And what you want to do, in my opinion, is find the right mixture of stock and bond to create the right risk portfolio so that if it does go down, you're okay. You don't have to be 100% in stock if that risk doesn't match your profile. Maybe you should only be 20% stock or 40% stock or what have you. But you have to understand that you don't know that if the market's going to go down. You might feel like it's going to go down, and I often feel that way, but you need to set that feeling aside, find the right mixture, and buy, because most of the time the market does go up. Look at it the last 25 years. We've had two big downturns in that time frame, and it's still up a lot. So, getting in there, it's not timing the market that's important as time in the market, if that makes sense. So the more time you're in the market, the more chance you have of kind of really benefiting from that. And so be careful with, I think the market's going to go down, because you're waiting and the market just goes up and what have you. And maybe you're right and it goes down, but if you have the right portfolio, then maybe it doesn't go down past your pain point, so to speak, and you can kind of hang in there and let it come back. And as that market comes down, sometimes it gives you some really good information, and you might be able to make a few adjustments in that downturn and then really catapult out when it starts to come. That's what we did during the pandemic. We bought some stocks, Apple and Microsoft, on March 5th. We did fantastic with those, and I bought those because they were holding up better than the market. I like downturns in the sense that it tells me, what the market really values. It's like a sifting mechanism, and that jumps out. So I would be investing at any point in time without the thought process of trying to figure out whether this is a top or not, as far as that goes.
Yeah, especially since, if you change your portfolio and you miss out on that upside, and you're really giving up a lot if the market just continues to go up when you predict it goes down. That's
Yeah.
a lot of money lost.
Yeah, and you can't really get that back very easily. I guess the only time I'd ever be cautious is when the market is actually in a downturn. For example, I think it was about the beginning of March, we froze new money going in, until I think about the middle of April, when things had kind of bounced up a bit. And all I'm doing there is that, the momentum has changed. The price crosses through the 200-day moving average. There's some warning signs that, I would heed at that point when we're truly in a downturn that's falling apart. But at the moment, we're in an upturn, no doubt about it whatsoever. And so trying to just guess that the next couple of weeks or months or quarters are going to be down, that doesn't work historically, at least in my opinion. So, I would be in there personally.
Cool. So our next question is, which type of insurance is better, like a cash value versus term?
Oh, that's a good question. We've actually been dealing with that some recently. So, a cash value policy, basically, what they're saying is that what we call permanent insurance, it just means it doesn't term out. So, term insurance might be 10 years or 20 years or 30 years, and you purchase it, you have no cash value, you just pay for it. It's sort of like auto insurance that you just pay, it just goes, except it expires at some point, depending on how long you choose. Whereas a cash value policy, you actually build up some cash, and you can keep that policy for as long as you keep paying the premium. Sometimes you build up enough cash that actually the cash will pay the premium, what they call a paid up policy. Um, Most of the times, term insurance works the best, because a lot of the issues that we have are term problems. So when I got my big term policy, it was because we had bought our house, we had two kids. I wanted to make sure that the mortgage could be covered. My wife worked with me, in my business, so if something happened to me, I wanted to make sure that she was taken care of and that college could be paid for. And so, and I bought a 20-year term policy because it was a term problem. Um, Most of the times, the cash value or the permanent insurance is much more applicable for long term, for having it for life type of issues. And that's where you're just trying to make sure there's enough money to pay into your estate for some reason. So It could be because you have a really big estate and you might have some estate taxes that you want to pay. It could be that you have some debts that are outstanding that you just want to make sure are, eradicated so that your estate can be kind of free and clear. It could be that you're just trying to leave more money to your kids, or maybe you have a huge IRA and you want to make sure that, the kids have that life insurance to pay the taxes, because now you have to pull the IRA out over a 10-year period. So you could get a life insurance policy. Now, the one advantage to a permanent insurance policy is that if you got that a little bit younger, it's a little bit less expensive, and hopefully you qualify. You don't have some medical issue that keeps you out of qualifying. And then you can keep that for the long term for your family to use for, whatever that might be. So they have two different purposes, and it kind of depends on the situation. I wouldn't say one's better than the other. I would say term is more common. It's a lot less expensive, and so that tends to make it fairly popular. Um, but I wouldn't discount permanent insurance either for the right situation. I do think there's a place for that.
Yeah, one of the situations that I've seen from friends is that they do a paid up whole life just for funeral costs and stuff like that.
Yeah.
It's like a small policy,
Yep.
and they never have to worry about them family worrying about funeral costs, and it
Yeah.
just stays with their life essentially.
Yep.
One payment, you're good for the
Yeah.
rest.
Exactly right. Yeah, and you can't do that in a term basis because there's no cash value to pay those premiums online, ongoing, and so it's paid up, which means you put enough money in to sit in the cash portion to pay the premiums for the rest of your life. Especially since it's smaller, it's not so onerous. I've seen some really, really big paid up policies for people. You have 100 million or something like that, where you're going to end up with a large estate tax issue. Some of those are huge in terms of what was put in there to make them paid up. But yeah, that's what life insurance has some advantages in that it comes into your estate without any income tax and no estate tax. It's not part of your estate if you set it up right. Right. So like if you use what they call an islet trust, which is what I have. And so that's, there's some really interesting tax advantages to life insurance too, that work out pretty well. So
Has life insurance changed kind of since like the state tax, the exclusion policy has gone up, and since now people can exclude 11 million plus versus a million or 2 million as a couple?
yeah, it's changed a lot. It was a topic of conversation much more often, because for a very long period of time you could exclude $1 million, and then if you went and got an A B trust, you could essentially double that and get to 2 million. And but you got a lot of people, especially here in this area, just with their homes and the stock from the tech company that went crazy that they worked at, and their 401ks and everything, that had more than 2 million, and the taxes were really high on a state tax basis above 2 million. And if you had some rental properties that you didn't want your kids to have to sell, these, I think they give you 9 months to sell. So it used to be a really big deal, and a big portion of our planning process was this concept of estate planning and the taxation, and insurance. Mostly you're going to want to use permanent insurance for that, because that's not a term problem. I mean, you don't know how long you're going to live. You want it to be there for the rest of your life. But when they increase that, it's where you can get 5.5 million, right? Instead of the 1 million each. That means with an AB trust now, you can go up to 11 million. That covered an awful lot of people. And so obviously there are a lot of people out there that have more than 11 million where it still applies. But it did make a huge difference, because going from 2 million to 11 million in estate value covered a tremendous number of people. And so, yeah, it made a big, big difference in terms of the planning process. There's still some other reasons to have it. One of the big things that has changed is the size of IRAs has grown dramatically in the last 10 years. Used to be a big IRA was $1 million. Now it's 5 million. And so you think about that, they have to withdraw that over a 10-year period. That's $500,000 a year theoretically on their tax return. And that's not including any growth. And so, that's fine. They have the money coming in, but if you wanted to make sure that you could cover that whole thing and maybe pay the taxes for your kids so they can get the net 5 million, that's another area that has come up. And so things have changed on the other side because of the growth of 401ks that are now IRAs, and the same issue with 401ks if you didn't roll it over. But anyway, that's a good point.
Yeah, it's interesting, and it's kind of cool how insurance can work for every situation if you have a specific need.
Yeah. Yep. Yeah. Very powerful.
So our next question is, in the past, we've talked about systematic withdrawals. Why do you prefer systematic withdrawals over strategy like the bucket system? The bucket system is the idea where you break out your account or your assets into kind of three categories. You have a short-term bucket, which is kind of you keeping cash in your bank for 1 to 2 years of expenses. Then you have this medium bucket, which is kind of your fixed income products with bonds, CDs there for 2 to 10 year time horizon. And then you have your growth portion, which is your stocks or anything that's 10 plus.
Yeah.
And then when a bucket gets depleted, you pull money from the bucket just above it, essentially. So if your cash is running low, you pull from the bond bucket.
Yeah. I guess we use sort of a modified version of pure systematic withdrawal because what we always do is we try to identify, how much money they really need in cash in the banking system. And if they happen to have excess, we do use that first because it's practically free. There's no taxes on it really because you can sell it without capital gains. And it's not paying anything right now either, right? I mean, nothing's getting an interest rate that's worth much in the banking system. And so and then you would, and just to be clear, then you would use the systematic withdrawal process, which is where you would say have a portfolio that is designed to match your risk tolerance. So let's just say we go through the process, we look at how much things have fallen in the past and all the different things that we do to try to identify the correct portfolio for the right person. And let's just say it's a 60% stock and 40% bond. So first we use their money market, the cash, banking assets to live off of until that got down to the level of the emergency funds that they want to make sure they keep. So we're not going to touch that. If during that time more cash comes in, then we use that too, right? So, but once we get down to emergency money only, all right, then we would move over into taking money systematically out of the 60-40 bond portfolio. And we just keep a certain slice in the money market and then distribute that usually monthly. And then, the money market will shrink back down and then we rebalance this 60-40 portfolio. So we're always able to keep a nice balance. And that portfolio always matches that client's risk tolerance, unless it changes. So we do have to keep up with that. But in essence, it's on their risk tolerance. So the other description of the bucket methodology uses the same concept with the cash that we do. I agree with that. But here's the problem with the next concept. So your medium years, you're going to withdraw from your fixed income accounts. And what would happen then, of course, is that let's say your 60-40 was your mix, right? That's the mix that matches your risk. Now you're spending down the 40. You're starting to spend that down. And all of a sudden you're older and you're at 80-20, 80% stock, which is outside of your risk tolerance, your personal risk tolerance. And we have a big downturn. You're 85 years old. And now you're freaking out because your portfolio has moved from one risk level to the next. So I like the systematic withdrawal concept better than the bucket methodology. And there may be some modifications of that I'm missing, but at least from what was described in the question, I like the systematic withdrawal methodology better than the bucket because the key aspect to investing is to be in a portfolio that matches your risk tolerance. You're not going to make any money if the risk of your portfolio is higher than you can tolerate. You'll make money for a while, and then the market will fall, and you'll freak out, and you'll sell out at some low point. And so if you're in the right portfolio, it'll fall and it'll be like, okay, I knew that was going to happen. It's still within my risk tolerance. I feel okay with that. And you're going to hang in there. And that's the best thing to do during these downturns is to be able to kind of hang in there. And so that would be my thing with the bucket methodology is just over a period of time, you're going to have just the last bucket that's left is going to be stock. So if somebody had a very high risk tolerance, that could work, right? That's fine. For somebody who is, who could easily be, and I had a 93-year-old client that was 100% stock and loved it and wouldn't ever buy bonds. I mean, that's just his philosophy, and there's nothing wrong with that. Everybody's got their own methodology for risk. But a vast majority of the people that I run into are much more closer in retirement, especially to kind of that 60-40 mixture. And, around that between 40% stock to 80% stock is the biggest chunk. And so you're going to be selling off the bond portions at some point and changing the risk of the overall portfolio. That would be problematic in most cases.
So essentially, for the bucket system work, you'd have to keep rebalancing all the buckets to keep the portfolio the same throughout, essentially.
Which is systematic withdrawal. That's
Yeah.
exactly what
So
we do. Yeah, that's right. I mean, because that's exactly what we do. When that money market runs down, we rebalance, and so we get, and all the time there's something happening that's making it get out of balance. The stock market's outperforming the bond market. All of a sudden, you're at 70-30 or something. Because the bond market went down, stock market went up. And so then, when we're taking the money out and replenishing that money market again to keep these systematic withdrawals going, we rebalance back to 60-40. And yeah, that's exactly right. And what you just described is the systematic. And so if you keep a fixed set of buckets, I mean, I get the concept. The concept makes sense because short-term money is to be spent sooner. And so cash is shorter term than bonds. You send that first, and then bond is shorter term than stock. And the longer you can let your stock stuff stay in there, man, the more you're going to make. And so I get it. I mean, that makes sense to me from a term standpoint, but it ignores the risk. And I'm telling you, I've been doing this for 35 years. And the number one thing I work on with clients on a regular basis is making sure that they know the risk. And we even have a company called Riskalyze that we use. They send out an email every quarter showing them this is what you could lose in the next 2008 type downturn. Here is, how long it would take to come back. And so every quarter, they're getting an idea of what type of risk they're taking in their portfolio, because we have found, over time that, when we get that wrong, those people lose money because they're in the wrong place and they lose money. They weren't in the right risk profile. So I think that's a really big piece of it. And I would say that trumps the other concept of taking money from shorter term things. The risk tolerance piece is I'd never, ever, ever violate that ever. It's the most important component of investor behavior.
cool. And so going off risk, do we have a question about should I change my how much I keep in my emergency fund after retirement because I'm not making any more money. I can't just replenish it just with my income.
Yeah. So here's the thing about emergency money that's really fascinating. There's all these rules of thumb. I have 3 months worth of expenses on hand or 3 years worth of expenses on hand for all kinds of different things. And there's some ways that you can actually, say, hey, I'm in a 60-40 portfolio, and you can model what would have happened in 2008 downturn. How much did it drop? How long did it take to come back? And you can say, okay, I want to make sure I can cover another one of those situations. So essentially, if I'm taking a systematic withdrawal, I can either reduce or eliminate the withdrawal during that period of time, go over to my emergency money and use that instead. And then when things recover, I go back to my normal systematic withdrawal, and it's going to recover quicker because I'm not taking anything out of it, right? And so you can figure that out. You can literally do the math by each type of portfolio and figure out exactly how much emergency fund you need for different scenarios. But one thing I have found about emergency money, it's super personal. And there's just no way around it. There's no analytical aspect of emergency money that I've ever seen really work. Some people feel like having $5,000 of emergency money is too much because they want to have everything invested all the time. It's just their belief system. And they believe that they can withdraw from that if they need to. Other people feel like 500,000 is just really not enough because it won't cover as long enough for me. And that's what emergency money is about. It's about sleeping well at night. And so whatever that number is. So if you get into retirement and you feel like you don't have enough emergency money, then yeah, you should be saving more money towards emergency money until you get to a spot where you feel good about that. And so that's the problem with all these rules of thumb. They don't take into account like just human behavior and people's thought processes and how they're dealing with, risk and whatnot. So it's very fascinating. It's a great question. So the answer would be yes, you should save for more emergency monies during retirement if you don't feel like you have enough. But that goes for any age. It doesn't matter whether you're 20 or 90. Your emergency money is something you have to feel good about. Look at your bank account and say, "Man, I feel great about having that," one way or another. So yeah, it's a good question. It's a hard answer, but
Yeah, and one of the nice things is when with us, if you ever need money, we can get it to you in a couple of days. If you
yeah,
need to liquidate something for some sort of emergency, your money's always there and
yeah,
accessible.
yeah. That's right. Liquidity in today's world has dramatically improved. We don't have commissions to sell. We use a lot of exchange traded funds, for example, and we don't have any commissions to sell those. So, it doesn't cost anything to get out. If all your money is in IRAs, you might have some taxes. So you can make an argument for having some money in cash for that purpose, but you can still get it out if you needed it. Again, it's an emergency, theoretically. And so, yeah, usually somebody calls on Monday, we can have the money in their account, Wednesday or Thursday at the latest. And so liquidity is not a huge issue. The only thing is, the market could be falling. But oftentimes that might mean some portion of portfolio is going up, so stock market falling and the bond market's going up, we can sell some of the bond pieces, rebalance it later, type of thing, so there's usually some place we can get money, which does mitigate some of the need for emergency, but it still doesn't answer the emotional need. I'm telling you, just from my experience, people still just need that feeling of having something. And again, sometimes it's a small amount. I've had quite a few clients who really, really don't like having a lot of money in emergency because it makes them uncomfortable, literally, to have money in an emergency account because they feel like it's not working for them. And I have other clients on the other end of that spectrum. So, there isn't any wrong or right there at all. It's just, what works for you.
Cool. So this is a long-term investing question. How
Hmm.
do expense ratios affect my long-term investments?
Hmm.
Should I always be going for the lowest cost investment that I can get?
Yeah. So that's a good question because the long-term part of it is important. So, for example, what they're asking about is what we call the internal costs of investing. So let's say you buy mutual funds or exchange traded funds, they usually have an internal cost. So let's say you have one group of investments and the average internal cost is 1%, and you have another group of investments that are much lower costs and the average cost is 0.1%. So the differential between those is 0.9% per year. So 10 years down the road, you've paid 9% more in internal costs on the more expensive one. 20 years down the road, you paid 18% more in internal costs. And so the longer you go, the harder it is for those higher cost pieces to really keep up with the lower cost pieces. And that's why cost is so critical over the long term. And so I remember I used to do a bunch of studies taking all of the mutual funds that had been in existence for at least 15 years and putting them all in order of internal expense. And I would take the top 25 most expensive mutual funds and compare them in rate of return to the bottom 25% least expensive mutual funds. And in almost every time frame, every 5-year time frame, every category over that 15-year time frame, the least expensive, the 25% least expensive, won. So the problem was that the group that was offering you this very expensive internal cost, their selling point was, well, we've got all this money coming in, we can spend it on research, we can do this, we can do that these other low cost people can't do. Well, they weren't winning. So whatever they were doing isn't working. And so, yeah, I would say there's some wiggle room there. I wouldn't always work with just the lowest cost. That would be Vanguard, by the way, at least in my experience. They're the only nonprofit out there. I would certainly have a lot of Vanguard, but there is some things that work better in certain periods of time. But I would be, if I'm looking around for investments or trying to create a portfolio, I would be looking in that bottom 25% least expensive category. And I would, and most of the times you'll actually find that exchange traded funds are cheaper than, mutual funds for the most part. And we can actually buy and sell those for free, and mutual funds still have a trading cost. So that makes sense too. But it's really, it really is important. It's way more important than people know. And you don't see it. Unless you read through the prospectus, and a lot of times it's just buried. You don't see that cost. So I do believe that it makes a big difference.
Is there any reason that you should always, go to the extreme of taking the cheapest one, or should you like say like the Fidelity free ETFs? They have a couple index ETFs that are totally free, no internal expenses, versus Vanguard, which
Yeah.
is very small expense.
Yeah. I guess the way I would look at it is I would take, for example, right now there's 2,443 exchange traded funds that I pull down off of Morningstar onto a spreadsheet on a regular basis. And one of the things I would do is then screen out and say, okay, show, rank them all by expense. And so obviously Fidelity is going to be at the top, being zero. And I would take that top 25% and say, okay, here's the group that I want to look at. And then past that, I'm really looking at how is it doing? How many different stocks do I have? What is the mixture? What's the target? And compare them. So if I'm looking at, let's say, a broad market index like Vanguard's VTI, I'm going to look at that compared to, say, one of the Fidelity indexes. And VTI has been doing incredibly well, and it's beating almost everything I'm looking at altogether. And so, I'm going to buy the one that's doing well, and because there's a lot of different reasons, and cost is one piece. Um, but like for example, the Vanguard VTI is only 0.03% cost. That's almost free. It's not zero. But if I had to choose that versus a Fidelity one that was free, I'm just going to be looking at the returns and the mixture and the industry segments covered, and those types of things, and trying to see, because once I get past the cost screen, I don't care anymore. I'm already in that 25. Now I'm looking at other things. And so I do end up with Vanguard a lot when I look at those other things. I just do in those particular categories, especially when you're talking about kind of the broad market exposure. Vanguard's really good at getting into. I mean, today I looked at iShares has a Russell 3000 ETF, which has 2,600 stocks. They also have a total stock market index, which has 3,600 stocks. Well, VTI has 3,806 stocks, right? So I'm just looking at that today. And so if you're looking for broad market exposure, I can't find one that has more than 3,800 stocks in it here for the US. If you want to pick the world, that grows. But just focusing on the US, that has the most number of stocks, which in this market right now makes a difference because there's no trends happening. The market, the money's moving around, around, around. I want to own everything I possibly can. So it's one of the biggest holdings we have as far as that goes. So anyway, that's what I would look at past the fee aspect. Just screen it out for relatively cheap. Let's go that way. And then from there's a whole bunch of other things you want to look at, because once you get down, because you could pay 0.2% and end up with a great account, and it could be much better than VTI, for example, over some period of time. So there's lots of options as far as that goes, but it's pretty interesting.
Cool. So there's another question about planning. How do I plan for different events like increasing capital gains that's been talked about in the news so many times?
Oh, that's an interesting one. I get asked this a lot, actually. You know, and the question's pretty straightforward. You really don't until it happens. Just look at what's gone on since the election. So if we look at capital gains, they said capital gains, top capital gains rate was going to go up to ordinary income, and they were going to increase the top ordinary income rate to 39.6%. So currently it's 20%. So that's big. It's a huge differential. And then you also include, kind of not the Medicare, the Obamacare, tax of another 3% on top of that, and all of a sudden, you're over 40% tax on capital gains that are over $1 million, right? Which isn't that common, but it does happen. And now, that was going to be attached to this infrastructure bill. Well, it didn't get attached to this infrastructure bill, at least at the moment. And now maybe it'll come up in someplace else. But I mean, just look at the progression of talk that has happened just in the last, 9 months. And you won't know what's going to happen. So basically, you want to react to what does happen. I do think it's way more important to take a look at long-term tax planning. That's a different scenario. So we know at the moment that they're going to start, at 72, they make you start taking money out of your IRAs and 401ks and such. And it could be a big taxable event if you have a lot of money there. What can you do to reduce that taxes? Because it's going to go on for the rest of your life. And then just wait until they make the changes before you get too carried away with trying to do different things. Um, and lots of people, I remember reading all these articles that all these people were making adjustments after the election, right after the election last year, taking all kinds of gains because they thought it would go up, and it hasn't. As a matter of fact, it seems to be more dead than alive. It might go up, but I wouldn't have been making adjustments based on that, honestly, on the possibility. I mean, it's the same conversation we had before about the downturn. Not investing because the possibility of the market going down. Man, if you can tell where tax law is going before it happens, or tell where the market is going to go before it happens, I want to hire you. I need you. I really do. I need you to come into my office, and I need you to tell me when the market's going to drop before it drops, and I need you to tell me what tax law changes are going to happen. So that's facetious, but it just sort of points out the fact that we can't tell. So it would be more reactionary. I call it projection. I'm going to make a projection that something's going to happen, or reaction. I tend to be reactionary with tax law. I tend to be reactionary with the investing. So somebody could say, the market's going to go down. That's a projection. I'm going to wait until it starts to go down before I'm going to make motion. And I've got a reactionary plan in place. I've been much more successful with reactionary planning and reactionary, investing. So that would be my outlook.
Yeah, and so all our plans are based on laws that we know of and been signed and set in stone.
Yep.
And so, for example, when taxes sunset in 2025, maybe you should be tax planning to take advantage of that before it sunsets.
Right. Yep.
So taking advantage of what is known, because you can't predict the future. None of us can. If we could, we'd basically be retired and be on vacation somewhere.
That's right. Yeah, no, I agree, right? So that's a great point. We know right now the tax law says that the tax brackets that we're looking at are going to sunset in 2025. All kinds of things are going to be adjusted back to what they were prior to the tax law change in 2017. Now, it is possible that Congress will extend the existing brackets forward and not sunset. But right now, I would be planning on sunset because that's the law, right? And not some other thing. So when we do, tax calculations long term for the required minimum distributions out of IRAs, we're including an increasing tax bracket after 2025. Now, again, knowing Congress, if they do make a change, it'll be right at the end, and so then we can deal with that. But that's a great point. Actually, it's a great example of just being able to kind of push that envelope only when something really is there. As far as that goes, I mean, even the infrastructure bill, that's one of the problems with like investing in front of it is, it's still hanging out there. It looks really likely. And you might make a small bet now because it's got through the Senate, and so I bet you it does happen. But you got to be a little careful because it might not. You never know what's going to happen. Once it is signed, then there might be some opportunity there too. So, unfortunately, with investing, it tends to be a little bit different. If you do guess right, you can do really well. and if you wait, sometimes some of the run is over. But there's always someplace else to go. I mean, Jim Cramer on CNBC always says, there's a bull market somewhere. I love that. It's pretty accurate. There's a bull market somewhere. Something's doing well, and just got to go find it.
So it's always better to jump on the wave than predict the wave.
I think so. I like to see that wave kind of developing and starting to come up a bit, not get on too early because sometimes they just don't develop, but, get on just at the sweet spot and then ride that. The problem we've had this year is that the waves have been just little like ripples, like little white caps on Lake Michigan or something. They just don't last very long. Last year, the waves were unbelievable. I mean, you could get onto something that had been going for 3 to 6 months and it would go for another 6 to 12. It was incredible last year. The waves were, and the trends were just insane. This year, it's just exactly the opposite. The least trending market market I've been involved in my 35 years, which is again why, we've made a huge move towards the broad market, because that's what you want to own. You want to own all 3,800 of those stocks, because it just keeps rolling around amongst all of them. Trends are a week, 2 weeks long, and so yeah, that's okay. The market is what it is. So sort of a bounce back from last year, really. All right. So that's the end of our show. I want to thank everybody so much for coming, and really, really enjoyed the show today. Again, if you're interested, you can subscribe. You can send us your email address to get on email, or you can set an appointment. Just hit the link to get to our website and set up a little 30-minute appointment. Love to talk to you about some of these things, and look forward to next Friday. Again, we do these every Friday from 12:15 to 1 p.m. And I want to thank everybody for coming. Thank you.